Stop looking at the charts, stop checking indicators, and stop asking whether this is just another pullback. Because what is happening right now is not a market move, it is a structural break. Today, January 6th, 2026, marks the moment when years of denial finally collided with reality. For over a decade, silver has been dismissed, mocked, and buried under layers of paper trading, algorithmic games, and institutional narratives designed to keep you calm and distracted. Every spike was called a fluke, every warning labeled fear-mongering, and every shortage explained away as temporary. But markets do not lie forever. They only delay the truth until the pressure becomes unbearable. And today, that pressure cracked something fundamental. This is not about 5-minute candles, RSI resets, or margin hikes. This is about power shifting quietly, then suddenly. While retail investors were arguing online, while analysts debated soft landings and rate cuts, one of the most powerful institutions in global finance changed its posture. Not slowly, not cautiously. It capitulated. The same system that spent years telling you silver was irrelevant just admitted, in plain numbers, that the pricing model itself is broken. That admission is the real alert. When institutions that benefit from suppression stop pretending, it's not because they've had a change of heart, it's because they are cornered. This video is not here to excite you or scare you. It is here to document a moment that will be referenced years from now as the point where the paper story collapsed and physical reality took control. What you're about to hear is not a prediction, it's a confirmation. And once confirmations arrive from the very entities that fought this outcome the hardest, the timeline accelerates whether anyone is ready or not. Why this moment is different from every false alarm that came before. For years, silver investors have been trained to doubt their own eyes. Every rally was sold as temporary, every shortage labeled logistical, and every spike blamed on speculation. That conditioning mattered because it kept people focused on price instead of structure. What changed this time is not volatility, it's behavior. Physical premiums are no longer reacting to spot price, they are leading it. Dealers are no longer competing to undercut each other, they are rationing supply. Large orders are being delayed, rejected, or repriced in real time, not because demand disappeared, but because inventory did. That is a critical distinction. In a normal market, higher prices bring out sellers. In a stressed market, higher prices reveal absence. Right now, the absence is what's speaking the loudest. The so-called pullbacks are failing faster, and floors are forming where resistance used to live. This tells us the market is no longer negotiating price discovery in the open. It's reacting to pressure behind the scenes. At the same time, institutions that once dismissed physical silver as irrelevant are quietly adjusting models, hedging exposure, and issuing guidance that contradicts their own past narratives. That kind of reversal doesn't happen because of charts. It happens because supply chains are signaling risk. When metal becomes difficult to source even at elevated prices, the entire paper framework starts to wobble. Chapter 1 is about recognizing that this is not a hype phase, it is a transition phase where ownership, delivery, and access begin to matter more than quoted numbers on a screen. The largest banks treated precious metals as controlled variables. Gold and silver were not markets to them, they were tools used to manage inflation expectations, currency confidence, and risk sentiment. When those banks spoke, the market listened, not because they were always right, but because they were always positioned. That's why a sudden reversal matters more than any price spike. When a historically bearish institution changes its language, it's not opinion, it's exposure management. What we are witnessing now is not a forecast meant to inspire investors. It is a warning meant to protect balance sheets. Raising long-term price targets isn't bullish enthusiasm, it's an admission that previous assumptions no longer hold. More importantly, recommending massive portfolio allocations to metals signals fear elsewhere. Banks do not sacrifice yield unless they see systemic risk. They do not tell clients to abandon productive assets unless they believe those assets are vulnerable. This is where silver becomes especially dangerous to the system. Unlike gold, silver is both monetary and industrial, and its market is dramatically smaller. You cannot rebalance institutional portfolios into silver without detonating the supply chain. That reality forces banks into a corner. They must acknowledge upside without triggering immediate panic. But even careful wording can't hide the implication. Paper exposure has limits, and those limits are being tested. Chapter 2 is about understanding that institutional capitulation doesn't happen at the top. It happens when insiders realize control is slipping and they need to get ahead of the consequences. The most dangerous pressure point in the entire financial system. Silver is not just another asset that can be printed, rehypothecated, or settled in cash without consequences. It is a physical material with real industrial demand, shrinking above-ground supply, and a paper market that has grown wildly detached from reality. For years, price discovery has been driven by derivatives, not metal. Futures contracts, ETFs, unallocated accounts, and synthetic exposure created the illusion of abundance, even as minds struggled to keep up with consumption. This worked only as long as most participants never asked for delivery, but that assumption is now breaking. When institutions begin openly discussing triple digit or even four digit silver targets, they are indirectly admitting that the paper to physical ratio is unsustainable. The historical ratios they reference are not predictions, they are stress tests. They reveal what happens when confidence collapses and markets are forced to reconcile claims with reality. At those levels, someone doesn't get metal, someone gets cash instead, and that is when trust evaporates. Silver is uniquely explosive because its market is too small to absorb institutional demand and too essential to be ignored by industry. You can't pause solar manufacturing, electronics, medical equipment, and defense systems without consequences. That means silver cannot simply be priced out of the system the way other commodities can. Chapter 3 is about understanding that this is not a rally narrative. It is a structural reckoning. The higher the implied targets go, the clearer it becomes that the system is preparing for a disorderly resolution, not a smooth adjustment. The physical market finally breaks away from the paper illusion. And this is the part most people are still underestimating. While headlines focus on spot price fluctuations, the real signal is coming from premiums, delivery delays, and inventory stress. Physical silver is not trading at the paper price anymore, and that gap is widening fast. Dealers are raising premiums not out of greed, but out of necessity, because replacing inventory is becoming harder, slower, and more expensive. Mints are facing bottlenecks, refineries are running near capacity, and wholesale bars are being absorbed before they ever reach public markets. This is how shortages actually begin, not with empty shelves overnight, but with friction. Longer wait times, sudden out-of-stock notices, limits per customer. When these signals appear simultaneously across multiple regions, it means supply chains are tightening at the same time demand is accelerating. And unlike paper contracts, physical silver cannot be created instantly to calm the market. Every ounce must be mined, refined, transported, and verified. That process takes time the system no longer has. The most important shift in this chapter is psychological. Once buyers realize that silver availability is uncertain, behavior changes permanently. People stop trading and start holding. They stop flipping ounces and start stacking defensively. That is when liquidity disappears. Chapter 4 makes it clear that price follows availability, not the other way around. When physical control moves from institutions to individuals, the market stops functioning the way it used to. At that point, paper price becomes a reference, not a reality, and the true repricing begins outside the charts. The focus from shortages to intent, because what matters now is not just that silver is disappearing, but who is taking it and why. This is where institutional behavior tells the real story. Large entities are no longer chasing short-term price moves. They are positioning for survival. Sovereign buyers, industrial users, and long-term allocators are locking in supply quietly, often off-market, through private contracts and direct refinery agreements. This removes metal from circulation without ever showing up on public exchange data. At the same time, banks and funds that were once comfortable rolling paper positions are being forced to reassess counterparty risk. When trust in settlement weakens, paper promises lose their power. This is why we're seeing a silent shift away from leverage and toward outright ownership. Industrial demand adds another layer of pressure. Silver is not just money. It is a critical material for energy systems, electronics, defense technology, and infrastructure. These sectors cannot substitute it easily, and they cannot afford interruptions. When industry competes with investors for the same finite supply, price becomes secondary to access. That competition is already underway. The key realization in this chapter is that silver is no longer being treated as a speculative asset. It is being treated as a strategic resource. Once that transition happens, volatility increases, not because the market is unstable, but because the old pricing model no longer applies. Chapter 5 shows that the silver market isn't overheating, it's being reprioritized. And when priority shifts from profit to possession, the entire structure of the market changes in ways that charts alone can't capture.
Hello friend, welcome to my YouTube channel. I hope all if you are doing great and having an amazing day. My name is Noor Baqi and I am really excited to start this new journey with all if you. You know this channel is not just about videos, it is about story and ideas and inspiration. I created this channel to sharing something positive every signal week. Sometimes we all need little motivation, and sometimes we just need a good story to smile again. Decide exactly what this channel is all about. You find understanding stories, real life experience, and powerful lessons that again change the way you think. I be uploading new videos regularly. So if you don't want to miss any of them, make sure to subscribe to my YouTube channel and press this bell icon so you get notification when you post something new. You support means everything to me, and to great we can build a community full of partnership, learning, and good vibes. So sit back, relax, and let us begin this amazing journey together. Thank you so much for watching, and welcome once again.